All right. Well, thank you all for attending Silverstone Financial's monthly market webinar for the month of August 2022. We're going to hop right into the disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed in this presentation. And past performance is not indicative of future performance. Please see our website for additional disclosures, silverstone.financial/disclosures. And throughout the presentation, you can please submit any and all questions using the Q&A button at the bottom of the screen. I'll be addressing them all at the end. And for personal questions or to set up a time to talk, you can email me directly at jeremy@silverstone.financial. So quick bio, my name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. To learn more about my experience or designations, please check out my LinkedIn. And Silverstone Financial, the firm, is a fee-only fiduciary RIA that specializes in wealth management and financial planning for Americans across the US. To learn more about us, you can check out our website, silverstone.financial/about us, and learn more about why it's important to work with a fee-only fiduciary advisor. So we'll hop right into what happened this month. This month didn't have that many high finance news headlines, but the few that did occur, I found were very interesting, and I definitely wanted to bring them up today. The number one, the one that was most impactful or most surprising, was that the euro hit parity with the US dollar for the first time since 2002. Now, there's a lot to unpack on that headline that a lot of people just reading the headline and moving on might not be catching. So for us Americans, and if you're going on a vacation to Europe, you can think of it as having that trip be about 15% less expensive. You're getting about a 15% discount. The euro and the dollar were trading 1-for-1. So for the first time in for 20 years, you're able to trade $1 US for €1. Before, the euro was more valuable, and it would take $1.25 or $1.15 to get that same euro. Now, what this means, though, for the global economy, for Europeans, is that it's making imports for those Europeans more expensive. And more expensive imports are going to lead to less importing from Europeans. And less importing, one of the reasons why they need these imports, is because of inflation. They're struggling to meet their energy needs because of the war in Ukraine and such, and Russia cutting off some of its supply. So the lower value euro would lead to higher cost imports, makes less imports, which then has a spiraling effect, which would cause higher inflation for those same problematic goods that they need to import. And then the euro could decline more, and we could see a spiral in the value of the euro. So it's something I've been watching closely, and is definitely going to be impacting the US, global, and European economies all. Is important, and I mentioned it last month, and I'll definitely bring it up again later on in the presentation, but we've seen the US dollar strengthening against a lot of currencies, not just the euro. And you can see a lot of that coming from that the inflation in the US, the economy in the US might not be in tip-top shape. Inflation is definitely too hot. The economy may or may not be in a recession, but we can see a lot of this inflation problem, a lot of the economies in other parts of the world are actually worse than the US. And because of that, there's a lot of foreign investors, a lot of foreign companies moving and putting more of their investments, their dollars, their currencies into US dollars, which is strengthening them even more. So there's benefits to having a strong US dollar, and there are downsides. The downsides is it's harder for us to export, and the upsides is it's easier for us to import. So we're definitely going to have to see what this foreign exchange shift in how our economies interact with each other are affecting the markets, something that is probably not as closely watched as it should be by non-professional investors. So a long explanation to a rather short headline, but it's an important one. The second notable event that I want to discuss was the Ukraine and Russia signing a grain export deal. And it would allow Ukraine to export a lot of what has been stuck in their Black Sea ports, and would help alleviate some of those problems in the commodity prices in the global markets. We definitely don't want to see unfortunate famines or other kinds of problems coming up from grain rotting in silos simply because of a war. So I'm really hopeful that this grain deal is one of many and won't fall apart, and would allow Ukraine to continue to maintain their position as a breadbasket. For those of you that don't know, Ukraine produces a lot of the calories consumed by the world, and this Russia-Ukraine conflict can have quite a few spiraling impacts. And I think this is a one step in the right direction. Hopefully we see more of it. The third notable event is not that important, but it is an important reminder to be cautious when investing. So the third headline that I wanted to bring up was that the SEC listed 9 crypto tokens as securities and charged a number of Coinbase employees with insider trading. And now that in itself isn't that important. However, I have been seeing continually so many crypto scams with like pump and dump schemes being offered and advertised to me monthly, weekly. It's very dangerous out there, and be careful where you're investing your money and how you're investing your money. And there's a lot of schemes out there that are very well advertised, very well produced to look extremely safe or extremely professional. Make sure if you want to invest in crypto or other places, you work with a credible source. You can even work with an advisor like myself. I do a little bit of crypto investing for my clients and use certain safeguards and certain techniques to try to minimize the impacts of all the problems in the crypto world right now. And then finally, we're going to discuss quite a bit about the Federal Reserve meeting and the Q2 earnings reports. It has huge impacts on the market. So let's hop right into the Fed meeting. So in July, just a week and a half ago, we had the Federal Reserve announce what was very much expected, a 75 basis point hike. So it went from 150 to 175 basis points range all the way to a 225 to 250 basis point federal funds rate range. So the 250, which you see here in blue, is a rather important number. So for the first time in his press conference, Jerome Powell, the chair of the Federal Reserve, he confirmed that he views 250 to be the neutral rate. And for those that don't follow the Federal Reserve or don't follow the importance of the Fed funds rate, the neutral rate has been a theoretical interest rate level that has been debated for a while. And him declaring what he views as the neutral rate was very important for the market. So what the neutral rate means is that when the interest rate is set to, in this case, 2.5%, the Federal Reserve does not see themselves as being either restrictive or accommodative to the economy. So if everything was going perfectly and the Federal Reserve didn't want to try to stimulate the economy or try to slow the economy to reduce inflation, they would just set it at 2.5% and let it run. Now, it's important to note it's a hypothetical. The economy is never perfect. There's always movement in the economy and different opinions, and it's always acting on past data, making future predictions. So it's theoretical. However, it's important to look at it because being at 250 basis points is significantly higher than where we started at the beginning of the year. Because of the pandemic, the Federal Reserve had cut us all the way to near zero rates, so 0 to 25 basis points, basically the lowest that you can go without going negative. And now, I'm not sure if it is the absolute historical highest rate hike ever, but going from 0 to 250 in such a short period of time is at least up there in one of the fastest rate hiking sequences in history. So we've seen quite a bit of jumping from 0 and then accelerating actually 0, 25, 50, 75 basis points very quickly. And now that we hit this neutral rate, a lot of the commentators, the analysts that watch the economy are saying, okay, well, now what? When they had basically shown us this plan, which they've stuck to slightly, they've been a little more aggressive than initially announced back in March and such. They had said by the end of the year, which you can see in this dot plot, by the end of the year, they want to get between 325 and 350 basis points. So we're 100 basis points off of that. So that means they see inflation as too high. They see that they need to be restrictive. They see that they need to go past the neutral rate. So if inflation was at 2.5%, and the economy was exactly where it was, then they would leave it right here. But inflation is still 8-9% right now. So they're going to go into this restrictive territory. But, and we'll discuss the performance very soon, but the market rallied this month on the press conference afterward, where Powell basically said in certain words that there may be rate cuts in 2022 or 2023, 2024. So essentially is that they're going to be data dependent. They're going to raise rates to about this level, and then they're going to see what happens 2023, 2024. And ideally, that soft landing that you may have heard of on the news, what would happen is, all right, they're hike rates up to 350, so 100 more, and then the inflation moderates, and then they bring it back down pretty rapidly back to the neutral rate. Now that would be the dream scenario. I don't necessarily see that happening. There's a lot that can happen between now and then, but a lot of uncertainty, a lot of fear that the Federal Reserve is going to crush the economy into a recession, very deep recession, and making it not worth basically fighting the inflation. That has subsided quite a bit in quite a few bears' minds, and so they have turned less afraid of the Fed and has spurred a rally in the markets this month. So let's talk about the rally in the markets. So this is a much better screen than I was able to show last month. There's a lot more green. It's good to see. This past month, the S&P 500 was up 9.1%. So that was quite significant. It actually was the best month since November 2020. So that was right in the pandemic when there was a recovery rally. So this month is topping that. We see the S&P 500 mega caps and small caps all in line 9 to 10%, having a solid recovery. The Dow Jones, which handled the drawdown throughout the year because it's more value oriented, having less of a recovery, but also had less of a crash earlier in the year. You see this again, which I had pointed out last month, and we talked about a few slides ago, that the global economy, so international markets, are doing worse than the US market, and that has to do with they're handling inflation worse. They're having more problems, and the U.S. market is still seen as safe, or at least relatively safe in comparison to many of the foreign markets. And this bond number is also quite interesting. Seeing bonds rally 2%. Bonds are low volatility assets usually. They don't rally significantly in either direction. They definitely have movements, but a 2% movement in a month is quite significant and shows a lot of health in the bond market, I would say. And we see that most likely to do with the Federal Reserve. They're projecting more strength, and the bond market is feeling less pressure and is worried about less rate hikes. There's that bond rally. We see gold still down slightly. Not surprising, because the rest of the market has rallied significantly. Gold usually goes opposite the market, but it still seems like a buying opportunity to me for gold. Gold has continued to fall in an environment that I feel like should be rallying, but it's acting at least average. It's not crazy in either direction. It's a fair investment, a fair hedge, but nothing to get super excited about. Now, crude oil was down almost 7%. It has to do with a number of reasons, but there's also the OPEC meeting, I believe, next week or the week after that coming out. And there's worries that, worries for the crude oil market, but a chance of flooding the markets or producing more oil, which is good for reduction in the inflation rate. So seeing oil down slightly is a benefit to the market. And this big number you see down here, Bitcoin rallied over 20%. Now to note, Bitcoin had quite a terrible beginning of the year, and this is a small jump back up, and we see that correlation to the rest of the market. It definitely has that correlation that was speculated and then mostly confirmed to the NASDAQ, to these tech companies, to these high risk assets. The Bitcoin is rather correlated. It's not a fully decentralized, not fully uncorrelated. It's interesting to see all of that going on. So year to date, quickly, still red, but less red than the month before. That rally definitely helped from an S&P of having lost about 20% to only having lost 13%. For a number of my clients, I already know that there's less worry, there's less stress. Seeing almost half of a number, going from 20 to almost 10, significantly less painful. And seeing that relief rally has definitely helped. You see mega caps doing slightly worse than the S&P 500, small caps doing slightly better than the S&P 500, and again, these global markets doing quite worse. The bond market down for the year, rising rates, exactly what's expected, and the rest as we have seen in the past. So I'm going to bring up the notable risks that you might notice are the same as last month, which says quite a bit. So quickly is of course, the global conflict with Russia and Ukraine causing supply chain issues, the COVID-19 pandemic also exacerbating those supply chain issues. All of that helping make inflation quite a big problem for the economy, and then that forcing the Federal Reserve to raise rates, do quantitative tightening. So all these negatives to the market. But you see, I haven't added anything from last month. I don't necessarily see or haven't noticed any new notable risks that have come up, no material ones that are large enough to be affecting the full market. And what that tells me is I see that a lot of these risks are likely priced into the market. If there are no new ones, and there have been plenty of time for the markets to work through these risks and price them into these assets, it adds more credibility in my mind to saying that it's possible that we bottomed. So let's see if we did bottom. So this is, I believe, the first time I'm showing the webinar attendees a graph like this. So these two graphs The VOO up here is the S&P 500, and down here BLK is BlackRock. It's the largest asset manager in the world. They have trillions of dollars under management. Now, they're very similar. They're correlated. The BlackRock is in the S&P 500, but you can see the chart slightly different. For those of you who've never seen a chart like this is called a candle chart. When it's green, it goes up. When it's red, it goes down. And you will also see lots of lines drawn on it and moving averages that help show some technical analysis. Now, it's important to note, I'm not a technician, I'm not an analyst, but it's important to follow what the technicals are saying when trying to determine when is the best time to actually put money to work, when to get into the market and such. So I like to see this BlackRock chart. I follow it quite closely because it's very correlated to the market. They hold a lot of assets. They make their revenues from AUM fees essentially. And you can see that right down here, 1, 2, 3, BlackRock had a multiple bottom. So oftentimes you'll see one bottom and then a second bottom. And what that would mean is that's a support level. So there are enough people out there that believe, in this case, at $600, the stock is worthwhile to buy if there's weakness. If someone's trying to sell it under 600, that's the intrinsic value. We're going to buy it. We're going to support that level. Now, oftentimes, when you see a third bottom, that's quite a strong support level. So in this technical, very rudimentary technical analysis, but it's unlikely that it would break down through this bottom without significant new material impacts on the analysis of the stock. There have to be quite bad news for specifically BlackRock, say like something bad happened to their management team. But since it's a very much a correlated stock to the rest of the market, there would have to be significantly new problems in the market. So like China invading Taiwan kind of thing, some big black swan event that would affect the entire market, that could break through a support level. But usually other than that, when there's such a strong support level, that's giving quite a lot of reassurance that it might be a market bottom. I had talked about in our June meeting right here, that this was almost certainly a bear trap, if you remember those words. And unsurprisingly, it traded within the range that was set and it fell back down. So a bear trap, or a bull trap, I apologize. A bull trap is people think it's the first bottom, it's a fake bottom, and we're going to retest that. So a lot of people got hurt investing too early. When we got to around here and this range gets tighter, it's called consolidation. There's more of a chance for assets to break up or down through a range. And with such a strong support level, in my, once again, basic technical analysis, you'd see it more likely run up. So all this being said, this high quality company I see as a proxy for other high quality investments in the markets. The S&P 500 is well diversified, has a lot of high quality companies, but it is 500 companies. Not all of them are as pristine winners or pristine balance sheets as say Microsoft or Johnson & Johnson or BlackRock, all these massive, massive companies that you don't expect to ever see disappear. So you can see the S&P 500 has more volatility, is less very tight with its trading, and has had less clear technical lines that can be drawn. So this long explanation, hopefully I haven't lost too many of my webinar viewers, but is saying I think it's fair enough to call a market bottom in high quality names. If you're investing in the creme de la creme of the markets, you can likely be very happy putting money to work here. Even if we retest the bottoms, even if we break through the bottoms, if your time horizon is 3 years out, I think you'll be very happy with these price levels. Remember, at the beginning of the year, we were at 900 on this stock, and now we're down to 600. That's 30%, 33% off. And I could easily see it back up to 900 in a few years. So there's a lot of benefits, or at least a lot of good omens for those that are investing in the right way with long-term horizons and investing in quality names. One thing to note is just because I'm saying that, say, a high quality name might be worthwhile. Other names, you've heard the meme stocks, the AMCs, the GameStops, most likely won't follow this trend at all. Or other stocks that are tied to specific markets, like the oil stocks. The oil stocks could be a very good investment. They could also be quite a bad investment. It depends on what the oil markets do. So this, I want to be very clear, should not be extrapolated to everything else. But for those of you who have money on the sideline that you've been waiting to put to work, looking at high quality names is the first place that you should be looking. And I would say, considering to dollar cost average, if you haven't started already, say a third of it this month, a third of it the next month, a third of it the month after that, trying to get a good average price and getting that money to work and not missing the bottom. For those that didn't put money to work last month, you can already see that you missed out on 10%. It's possible, it likely is we'll give back some of that 10%, but still you don't want to miss out on all of these great rallies at the bottom. That's where a lot of the money is made, usually, is that bottom. So in conclusion, if you are looking to do something and looking to make active choices in your financial picture, putting money to work, dollar cost averaging, doing some tax loss harvesting. So that'd be rebalancing your portfolio, selling your biggest winners, your biggest losers, and offsetting those taxes. And looking at Roth conversions, for those of you that applies to, those often work best at a market bottom or when the market is down. It just gives you more impact for your money. All of those are great things to consider. And if any of you have any questions about that, I'd be happy to talk to you about the best names or the best ways to invest or to take advantage of these strategies like tax loss harvesting. So I hope I didn't lose too many webinar viewers on this rather nitty-gritty finance jargon over here, but I'd be happy to take any Q&A questions and try to have everyone ready for this next month. That's probably going to be another interesting one. I'm not sure if we'll be up or down next month when we do the webinar, but it'll be very interesting to see what's next. This month is definitely going to be impactful. So I have one question about just explaining a little bit more about the tax loss harvesting. I won't go too deep into it, but it's say you have $100 gain on Apple and you have $100 loss on Google. If you sold both of them, then you get a $0 net gain or loss, and that allows you to tax loss harvest the losers and cash in your winners and rebalance into whatever is going to be most profitable, most correct for the future investing. Oftentimes you see movements in the market, and what you're currently invested in isn't necessarily what's best to be invested in, but you stay with what you have, because if you sold, you'd have to pay taxes on it. So this kind of allows you to get around having to pay taxes and allows you to get into the best names for the current scenario in the markets. So hopefully that explains it without going too in depth with that. And I have another quick question about the chances of a recession. There's definitely been talks about are we in a recession? Are we going to be in a recession? If you listen to CNBC or any other kind of news network, you'll definitely hear quite a few commentators talk about it. Technically, we had our second negative quarter of GDP growth. And for the textbook, that would say that we are in a recession. However, it is called by, I forget which organization, but there's a specific organization that calls it, and they haven't called it yet. that we're in a recession. And they might not, because it would be extremely mild of a recession. I think it's important to note that the word recession is big and scary, but should not be considered a reason to buy or to sell the market. The market is forward-looking, and recession is based off of lagging indicators. So selling now, when the technicals and a lot of the sentiment is telling me that we're at a bottom because there's fear of a recession, doesn't make that much sense. And it doesn't matter if we're in a recession now, if in 6 months inflation is taken care of and there are no more recession fears, which isn't a guarantee, not at all. But if that happens, remember, the stock market is 6 to 9 to a year, months looking forward, forward-looking, and you want to be investing not worried about what has happened rather than what will be happening. So I hope that answers that question, and I'd try not to worry too much about what commentators are saying about recession, not a recession. Invest for the long term, and you should be okay. So I think those are all the questions. I don't see any others. If one of them isn't showing up, please email me or message me, and I'll write an email and with my explanation out to you directly. So I'll finish out here with disclosures, and I just wanted to thank you all for attending again. It's great to see you all, and I see a couple new names attending, so I hope to see you come back next month, and hopefully I'll have continued good news to share on that front. So have a great night, everyone.